So good evening to all. We'll start this balance sheet management. So basically, balance sheet management is totally about the balance sheet of the bank. We are discussing, entire balance sheet management topic is about the balance sheet of bank. It is not the balance sheet of any other company to whom actually we lend or something. It is our own balance sheet. How to manage the balance sheet, that is the balance sheet management. Okay. So as we know that what is the objective of risk management? What is the main objective of risk management? Risk management topic we have completed. What is the main objective of risk management? Okay, to avoid bankruptcy, we have to strengthen our capital. So capital is the main concern for risk management. Entire credit risk, market risk, operational risk, everything points out to the capital one. So we have to not only maintain the minimum capital, but also strengthen the capital. As we grow up in business, our business grows, we have to also increase our capital. Capital has to be also strengthened. So basic purpose is to strengthen our capital so that we will avoid bankruptcy. So bankruptcy will not be there. We should not close our door. The business should not be closed. That is the main purpose. Now, from this also we know that capital comes from capital. Every year capital is strengthened through the capital profit only. So we have to also increase our profit. To increase the capital, main thing is to do the business and increase the profit. So increasing the profit is also required to increase the capital. So that capital is total maintained and capital is strengthened so that our business goes on continuously. It is not closed or we should not face any bankruptcy. Now this profit is the main concern. Now how the profit should be increased? What is the objective? How we can increase the profit? Because if profit is not there, we cannot provide for the capital. So profit is the main concern. So the main how to increase the profit is basically the balance sheet management. If you manage the balance sheet properly, then you can easily increase your profit. So risk management and balance sheet management are totally interlinked. Both has to be done efficiently. Risk management has to be done as well as balance sheet management has to be done. So the objective of balance sheet management is to maximize profit. How to increase profit? Because entire business, whatever you are doing, basically the core business is accepting deposit from the public for the purpose of lending and investment. So three core business: deposit you accept, then it is used as a loan or investment. So that means both liability and assets side are used by the bank to earn the profit. So entire balance sheet, whatever the items are there, certain main items are there which has to be managed efficiently to increase the profitability of the bank. If you cannot manage that, then profit cannot be increased. If you cannot increase the profit, you cannot strengthen the capital. So when you cannot strengthen the capital, you cannot save your bank. So those are interlinked. Okay. So this is about the balance sheet of our bank. So what is a balance sheet? Balance sheet is basically a financial statement which records assets, liability, and capital. Asset, liability, and capital. These three main components are there. Left side in our India, in the balance sheet, left side is the liability side, right side is the asset side. And capital is also at the top of the liability. Capital is also a liability thing. Okay. So balance sheet, we can say that it is a quantitative summary. It is a quantitative summary of any company which depicts the financial condition at a specific point of time. So balance sheet is always at a specific point of time only. It is not about the period. Okay. So balance sheet is a quantitative summary of any company or any concern or firm which states the financial condition of that company or firm at a specific point of time, which includes asset, liability, and capital. So balance sheet is for a period, it is for a day at particular time. So normally it is published in the quarter or annually. So you will see that balance sheet as on 31st March of any year, 2026. So whatever the items of asset, liability, capital is mentioned in the balance sheet, that pertains to this day only. It is not for a period. On this day, what are the items of balance sheet are there? Those are the figures. But if you see the profit and loss account, profit and loss account is not for a day, not for a specific point of time, but it is for a duration. It is always for a duration. It can be for a week, for a fortnight, or for a month, or quarter, or year, whatever it may be. So P&L is always for a period of time or a duration, but balance sheet is for a day, on a specific day. Okay. So that is the difference. Now, the equation of balance sheet, if you see the equation of balance sheet, normally it is depicted as asset is equal to liabilities plus capital. This is the correct equation. We can say that in balance sheet, asset is equal to liability, also correct. But asset equal to liabilities plus capital, this is the correct equation. Because why this is correct? Because in this case, if you say that, suppose I will say that asset equal to liability. Say asset is 100, liability also 100. So this simple thing is that balance sheet is to be balanced, so asset and liability are balanced. There is no problem here. But if you give the figure as liability plus capital, so in that case, suppose I say 100 is the asset equal to 70 is the liability, 30 is the capital. If you express it in this way, the person who is looking into it, he will see that 30 rupees is the capital. So capital means the strength of the company is also mentioned here. If it is within the 100, that is 30 is already within the 100, but 100 is doesn't show the strength of the company. But here 30, if you see, then you can express that how strong your company, what is your capital. And by this equation, what is another thing meaning is that, see, this liabilities, whatever the liabilities are there, actually these liabilities are basically the outside liability. Outside liabilities means they are to be paid to outsider. But capital is a liability, but it is not to be paid to outsider normally. Normally, they are the owner, whoever invested the money as capital, or capital comes from the profit. So bank is the owner, and the investors are also partially owner of the bank. So this is inside liability. These are inside liability. So basically that means if you know that 100 is the asset, 70 is the liability, 30 is the capital, that means if you sell the entire asset, which will fetch you 100 rupees, out of which 70 rupees is belonging to outsider, so you pay up 70 rupees, 30 rupees is still belong to the owners. So that's why the correct equation is always asset equal to liability plus capital. Okay. Okay. And this balance sheet, another thing you should know that balance sheet, so bank is a company. So basically all the financial statement, whatever is prepared by the companies or corporates or banks or firms, actually they are guided by the Indian Companies Act. Indian Companies Act 1956 and 2013 This total Indian Companies Act tells that how to prepare your financial statement. Financial statement means your balance sheet, then your profit and loss, cash flow, fund flow, whatever the statements are there. Entire thing is governed by Indian Companies Act. But banks are also company, but for banks are governed by another act, which is which act? Banks are governed by Banking Regulation Act 1949. Okay. So for bank, there is a special act is there, which is Banking Regulation Act. Although bank follow the all the things about the balance sheet, everything which is depicted in the Indian Companies Act, but there are certain instructions given in Banking Regulation Act also how to prepare the balance sheet. Okay, so basically, so balance sheet of banks are prepared as per Form A. Form A. Write it right then. Form A of the third schedule. Third schedule of Banking Regulation Act. Okay, so balance sheet. How to prepare the balance sheet? It has been described in Form A of third schedule of Banking Regulation Act, and the profit and loss is prepared according to Form B of the third schedule of Banking Regulation Act. Sometime question comes, so you have to remember that. Okay. Another thing that if you see the balance sheet, this is the bank's balance. Liability side starts with the capital, then comes reserve and surplus, then comes deposit from public, then comes borrowing, then other liabilities. In the asset side, it starts with cash in hand and cash balance with RBI, then balance with the banks, money at call or short notice, investment, loan and advances, other assets and fixed assets. And there is another thing called contingent liability, which is outside the balance sheet item. So if you look into these items of the balance sheet, you can see that there are five schedules in the liability. There are five schedules in the liability. So basically, total balance sheet, if you see, balance sheet and profit and loss, if you see, balance sheet is the main thing. For bank, cash flow and fund flow are not the financial statement. Financial statement means balance sheet and P&L. Okay, so together, this balance sheet and P&L are called the financial statement of banks. And this financial statements, entire financial statement contains 18 schedules in total. Total 18 schedules are there. Out of which there are 12 schedules in the balance sheet and there are 4 schedules in the profit and loss, plus additional 2 schedules are there which are enclosed as annexes. So total 16 schedules are prepared by banks. Bank balance sheet contains 12 schedules, P&L contains 4 schedules, and there are 2 annexers which are schedule 17 and 18. Okay, so basically these are the things. So if you see, there are in the liability side, there are 5 schedules. In the liability side, the 5 schedules, 1, 2, 3, 4, 5. In the asset side, there are 6 to 11. So 6, 7, 8, 9, 10, 11. There are 6 schedules. So 5 schedules in the liability, 6 schedules in the asset, and there is another schedule which is called contingent liability. Contingent liability, which is the outside balance sheet, off balance sheet item, that is the 12th schedule. So 1 to 5 are liability, 6 to 11 are assets. Contingent liability is a 12th schedule. Okay, so this belongs to balance sheet. Now, as far as the profit and loss is concerned, profit and loss concerned, 13 and 14. 13, 14, they comprise the income. This is the incomes. Income means 2 types of income there. First is your interest income, which is a 13. 14 is your other income. So 13, 14, 13 is the interest income, 14 is other income, which are not interest. Okay. And 15, 16, basically they are the expenses. They are the expenses. So 15 is your interest expenses and 16 is your operating expenses. Operating expenses, which are not interest. Okay. So 15, 16. Now, apart from that, there are two more things, Schedule 17 and Schedule 18. Schedule 17 is an annexer which describes or narrates the entire significant accounting policies, which are significant accounting policies followed by the bank. Accounting policies followed by the bank while preparing this balance sheet and P&L. What are the different accounting policies followed? Okay. And Schedule 18 is called Notes to Account. Notes to Account. So what are the significant accounting policy? Accounting policy means, see, in the balance sheet, you will not find anything, or P&L might be figured like depreciation is given. So depreciation total figure is given in the P&L. But you do not know what is the depreciation, how much depreciation is there, what method is followed. So those things are what accounting policy means, what type of depreciation you are following, which method you are following for what. Everything are narrated in Schedule 17. Similarly, foreign exchange, some policies are there. So those accounting policies are to be given in Schedule 17. Notes to account is the total explanation of all the items appearing in the balance sheet and P&L. Because in the balance sheet, only one head is there. So capital, this much amount. What type of capital, where it's different types of reserve, surplus. So what type of reserves are there? Then deposit, what type of so current deposit, how much, savings deposit, how much, then FD according to tenure, how. So all the details, if you want to see, somebody wants to see, they will find all the details of balance sheet items and P&L item in the notes to account. Okay. So these are the details of the balance sheet. So as per the Companies Act and Banking Regulation Act, every bank which has issued its own shares and their shares are listed in the stock exchange, they have to prepare and publish the financial statement every quarter. If the banks which has not issued their share, they have not issued share, they may publish annually. They can publish quarterly also, but for them this is not mandatory. But those banks which has issued shares and public has invested in that, and those shares are listed in stock exchange, it is mandatory that they have to prepare and publish the financial statement quarterly. So this is the basic things about balance sheet and P&L. Now, these are the balance sheet I have told you. And little bit of things I do, all the items you know, so there is nothing to worry. So capital, capital is basically first time the capital comes from the owner's fund or shareholders fund. They will invest, that is taken. After that, capital is coming from the profit, you increase the capital. Okay. Then comes reserve and surplus. Reserve and surpluses are coming out from the profit. Whatever the profit banks are earning, they are part of the profit are kept under the reserve and surplus. Okay. Then deposit. Deposit might be say demand deposit or time deposit. Then borrowing. So whenever bank borrows, whether from RBI or for any other bank, it might be a short-term borrowing or long-term borrowing. So that is part of it. And there are certain other things which are called other liabilities and provisions which are held by the bank. Similarly, if you go to the asset side, first is the cash in hand or cash balance maintained with RBI. Second is some accounts are maintained with banks also. And certain times bank also lend money to other banks, which is their borrowing. So these are called money at call or money at short notice. Money at call means it is overnight money which is lent. Short notice means up to 2 days to 14 days money which are lent. Then investment portfolio, which can be a short-term or long-term investment. Then loans and advances, other assets, and fixed assets. So these are the different items, out of which something you should know about the reserve and surplus. So I will tell you about the reserve and surplus. What are the reserves? Okay. So yes. Owners means shareholders. Basically, they are the shareholders. So it is not bank's money. It is the money put by the shareholders or owners in the business. So bank is totally separate from the owners. Okay. Now, yes. When the bank earns profit, whose profit this is? Shareholders. So that profit is kept in a reserve. Part of the profit comes to the reserve. So whose money it is? Owner's money. So bank has to pay it to owners, right? When the bank is to be liquidated, it has to be paid. So that's why reserve is not bank's money. It has to be also paid to somebody else. That's why reserve is also a liability. Reserve is basically a fund which is created by the bank. It is not a capital. Why it is separated from capital? You can put that money in capital also, there is no problem. But it is not put in the capital. It is kept in a separate head called reserve and surplus. Why? Because we know that capital is untouchable. You cannot use the capital. Regularly, you cannot touch the capital. You are not allowed to touch. When you are allowed to touch, or you can increase the capital, but you cannot withdraw the capital. Only capital will be used when the bank wants to close down its business. When bank faces bankruptcy, at that point, or bank is facing continuous losses, then only that can be appropriated from the capital. Okay, because first avenue is that whatever losses are there, they can be appropriated from other sources first. If all the sources are exhausted, last source is capital. You are allowed to touch the capital at the end only. So you cannot use the capital. So for that purpose, another separate account is created, which is the reserve and surplus, where the profit can be kept there, so that whenever certain exigencies are there, bank can use that from the reserve. It is allowed to use the reserve, but you cannot touch the capital. If you all the profit you can, if you are parking in the capital, you cannot use that. Reserve can be used at any point of time. So that is the purpose for which capital and reserve are separately made. And these two together, capital and reserve together, is called the net worth of the company. Whatever the capital plus reserve amount comes, that becomes your net worth. This is called the net worth of the company. Okay, so bank's net worth is capital plus reserve. Now this reserve comes from the profit and loss. Profit, normally it is from profit, certain amounts are set aside and they are parked in reserve. Because whatever things we are earning, finally the retained profit will be there. So retained profit can be put in the surplus and some part are kept in the reserve. Okay, so that is the, so how to use that reserve for that purpose? There are different types of reserve accounts are also opened by the bank. Basically, there are three types of reserve. One is your called revenue reserve. Revenue reserve. What is revenue reserve? Revenue reserve, from where the money comes, revenue reserve are created out of the profit which has been earned by the bank in the normal course of day-to-day business. So it is from the normal course of banking business. Whatever the profit earned by the bank in the normal course of business means From the banking business, whatever the profit is earned, part of that profit you can park in the revenue reserve. Okay. So revenue reserve can be classified again into two types. So there are two types of revenue reserve account banks create. One is called your general reserve. General reserve. Another is called specific reserve. General reserve. General reserve means whatever amount you have parked in general reserve, it can be used by the bank for any purpose. There is no specific attachment to this. There is no, you can use it for anything. Bank can use that. That's why it is called general reserve. But specific reserve means different types of heads are created. Different types of heads are created. Means suppose this is created for, say, staff welfare fund. Staff welfare fund. So some amount you put in the staff welfare fund. That means this amount, whatever the amount you have put here, that has to be used for staff welfare only. You cannot use for any other purpose. So that's why it is named as specific reserve. Okay, so like investment fluctuation reserve means that has to be used for investment fluctuation when it happens. Whenever losses happen, that has to be used. Surplus is at the liability end side. The surplus means retained profit, P&L. Normally, your P&L account, whatever your return profit is there at the bottom, in the P&L account, you will see that at the bottom, your net profit or your retained profit is there. Okay. Now, this P&L retained profit is a credit balance. So this credit balance has to be also given in the balance sheet to make the balance sheet balance. So this P&L will come into the surplus account. This is kept in the surplus account. Okay. So suppose your net profit is, say, 100 rupees. Okay. Net profit is 100 rupees. Suppose you want to put something in the reserve account, then say you have decided that 50 rupees you will keep it in the surplus account and 50 rupees you will put in the different reserve account. So in that case, different reserve, general reserve, specific reserve and other reserve, you put that 50. Then in your surplus account, another 50 will be there, which is your net profit. Okay, is it clear? Second type of reserve is your capital reserve. Capital reserve. Now, what is this capital reserve? Revenue reserve comes from the banking profits. Profit earned by the bank from the day-to-day banking services. But capital reserve does not come from the banking profit. Where from it comes? They are created out of the capital profit. Such as if you are selling, suppose sale of some fixed asset. Sale of fixed assets. Suppose you are selling some building or vehicle or whatever fixed asset is sold. They cannot be credited into the P&L account because they are not banking activity profit. So those are to be kept in the capital reserve account. Say profit on, say after selling you have earned some money. So selling of fixed asset or suppose you have revalued your asset, revaluation of asset, revaluation reserve is created. So that is a capital reserve. Or any security premium you have received on issue of shares or debenture, bank has issued share or something that where premium. So that is part of capital reserve one. So capital reserve is not from the banking profit. It is from sale or utilization of capital profits. This is capital profit. It is not the operating profit of the bank, which bank earns from the day-to-day business. Okay. Now, third type of reserve is your statutory reserve. What is statutory reserve? Okay. So, these are mandatory. Bank has to maintain certain amount, percentage of NDTL as cash with RBI. That is called cash reserve ratio. Apart from that also, bank has to maintain certain percentage of NDTL as other securities or gold or cash or other instrument which are kept inside the bank. Those are called SLR. So there are three type of reserve. One is your revenue reserve. Second is your capital reserve. Third is your statutory reserve. The revenue reserve is of two types: general reserve and specific reserve. Okay. Apart from that, another part of the thing is also kept in the reserve and surplus account. That is called the share premium account. Share premium, which is part of the your tier 1 and tier 2 capital, all three capitals. So that is called share premium. Now, share premium, what is share premium? Share premium means suppose bank issues shares. Suppose bank is issuing the share. Normally, shares are issued as 100 rupees per share. It is issued. But as per the bank's stature in the market, a bank's business and a market capitalization or thing, bank want to issue the share at a premium value. So bank says that yes, 100 rupees, the value of the face value of the share is 100 rupees, but I will ask for 140 rupees per share. That means suppose investor wants to buy one share of 100 rupees, he has to pay 140 rupees. So there is a premium of 40 rupees has to be paid by the investor. Okay. He is paying 140, but he is getting a share of 100 rupees only. Now, this 40 rupees, which is the premium, this is kept in the share premium account. So 40 rupees go to share premium account and 100 rupees is kept in the capital as paid up capital. It is a capital or it is a paid up capital. 100 rupees goes to paid up capital, but 40 rupees goes to share premium. And this share premium is bank's property. This is not paid to the investor. This will not be paid. When the suppose bank is closing down the entire thing, bank will pay 100 rupees only to the shareholder. Okay, so share premium becomes bank's own property. So it is kept under a separate account. Okay. Now, apart from that, contingent liability, it is a off-balance sheet item. So your bank guarantee, LC, and derivatives, they are part of this contingent liability, which are not the balance sheet items. They may become balance sheet item in future if it happens. Okay. So this is about the balance sheet.